All right, let's jump right into this explainer and systematically break down the true anatomy of a wick. And we're doing this strictly from the perspective of an institutional market analyst. Look, if you've been staring at charts for any length of time, chances are you've been treating wicks as, well, just simple decorations on a candle. Or worse, random market noise. But today, we're going to completely flip that script. We're hunting for institutional footprints, and we're going to learn exactly how to read the market's truest intentions. Let's get into it.
So here's our rapid-fire roadmap for today. We're going to redefine the wick as a gap, pin down consequent encroachment, qualify valid wicks, explore time frame hierarchy, and finally, wrap it all up with a highly actionable lower time frame execution model.
Starting off with Section 1, the wick as a gap, unmasking those institutional footprints.
Most retail traders just stare at the candle bodies and brush off the wicks as random chop. But a wick is actually a massive footprint of rejected delivery. Think about it. To form a long wick, price literally has to travel way out to an extreme and violently snap back, all inside the lifespan of a single candle. That round trip is incredibly fast. And fast, one-directional movement leaves an imbalanced, undertraded band of price. So in reality, a wick is a single candle inefficiency.
Think of a candle like a super fast auction. The body, that's where buyers and sellers finally shook hands and agreed on an accepted price. But the wick is a violent, aggressive refusal of price. An upper wick tells us price tried to push higher and was instantly swatted down by sellers. A lower wick means price tried to tank and buyers stepped in hard to absorb it. Rejection, frankly, carries far more treatable intelligence than simple agreement ever will.
Because that spike out and the rejection back happens so ridiculously fast, a wick is essentially a gap wearing a disguise. The market has this incredibly strong algorithmic tendency to return to inefficiencies to rebalance them, right? It wants to trade back through those under-auctioned prices. So when price eventually comes back to a prior wick, it's really just coming back to fill a gap. Understanding that completely changes the game on how we draw our actionable levels. Moving right along to Section 2, consequent encroachment defined, finding the 50% equilibrium.
To the institutional algorithms running the show, these wicks are viewed exactly the same as gaps. And the mathematical midpoint is absolutely crucial here. Just like the midpoint of a fair value gap is its most sensitive equilibrium point, the exact same logic applies to a wick. In the institutional playbook, we call this midpoint consequent encroachment. Now, the way we mark consequent encroachment is specific. You've got to measure from the body edge, right where the open or close sits, all the way to the extreme tip of the wick to find that perfect 50% line. A ton of traders try to enter right at the extreme tip, thinking, hey, my stop loss will be tiny. But here's the reality. The tip frequently never gets retested, meaning you literally sit there and miss the whole trade.
This midpoint is your ultimate line in the sand. Price respects this 50% level far more reliably than the wick's outer edge. If you see a return that taps the wick and aggressively reverses at or before consequent encroachment, that inefficiency is being fiercely defended by institutions. But if price just slices cleanly through that 50% mark, the wick is fully rebalancing. It's losing its power as support or resistance, and you need to step aside.
All right, Section 3, qualifying valid institutional wicks. Time to filter out the noise.
The contrast between a tradable wick and garbage is stark. A strong wick sweeps resting stops and displaces heavily away. A weak wick, it just pokes into empty space with zero follow-through. Look, if a wick doesn't run an obvious liquidity pool, like a set of equal lows or the previous day's extreme, it didn't collect any orders. It has absolutely no reason to be defended. No raid means no trade, period. I don't care how long the wick is.
Let's break down this checklist and listen closely, because qualifiers 1 and 2 are absolutely non-negotiable. If a wick doesn't run an obvious pool of stops and then reverse with massive energetic displacement, meaning a really strong, fast close away from the wick, it's just not a setup. The other 3 qualifiers, being in a high time frame premium or discount, having time frame authority, and getting a structural shift, those are what upgrade it from a maybe to an absolute A+ institutional slam dunk.
You can use this rapid scorecard to grade a wick in literally under 10 seconds. It completely removes the emotion and the second guessing from your analysis. If you're scanning fast, just ask yourself 2 questions. What did the tip take, and how decisive was the rejection? If it took obvious liquidity and rejected violently, you've got an institutional footprint. If it just sort of drifted into mid-range chop, ignore it, walk away, protect your capital.
Which brings us to Section 4, Time Frame Hierarchy and Liquidity, establishing top-down authority.
There is a strict institutional rule that forms our authority ladder. Time frame always beats time frame. Sure, every wick prints on the chart, but not every wick is binding. A daily wick reflects a massive, highly capitalized pool of institutional decisions. That daily wick is going to outrank a 5-minute fair value gap every single time, without fail. We have to read the chart top down and let the highest time frame be the boss.
And it's fascinating because when you really zoom in, you get literal proof that a higher time frame wick decomposes into lower time frame execution arrays. A daily wick isn't just a single line. It's a rich, complex trading zone. When you drop down to a 15-minute or a 5-minute chart, that one spike expands, revealing the lower time frame order blocks, the gaps, and the micro-liquidity sweeps that actually built that big, higher time frame rejection.
Inside these wicks, delta outliers show us exactly what's happening under the hood. It's aggressive buyers being totally absorbed by passive institutional sellers, which triggers the displacement. If you watch the order flow inside an upper wick, you're going to see massive blue delta. Literally hundreds of aggressive retail buyers just hammering the ask, but price goes nowhere. It's absorbed like a sponge. That absorption traps those buyers, meaning passive institutional sellers are completely in control, and that inevitably leads to a massive breakdown.
Section 5. Lower Time Frame Execution Model. Let's talk about the nesting workflow.
Okay, this brings all the theory together into a mechanical, top-down nesting workflow. This gives you a high time frame, high quality location paired with a microscopic lower time frame risk profile. First, spot your qualified daily or 4-hour wick and mark that consequent encroachment line. Then, you sit on your hands, you wait patiently for price to pull back into this zone. Once it's inside, drop to your lower time frame, wait for a structural shift in your direction, and execute.
You absolutely must remember the fractal rule. A 1-minute bearish wick inside a daily bullish wick is just the noise building your long entry. It is not a reason to suddenly flip short. The lower time frame gives precision, the higher time frame gives permission. Actually, think of it this way. A 50-point wick on the NASDAQ is probably way too wide for a direct stop loss, right? But by nesting your lower time frame entry inside of it, you capture that massive institutional context while keeping your retail risk incredibly tight.
And when you're setting your targets, you want to hunt for those older, higher time frame unfilled wicks. The algorithm will naturally draw price back to rebalance those old inefficiencies. Wicks aren't just for entries. They are literal algorithmic magnets. A genuinely strong trade runs from one piece of swept liquidity directly to an opposing pool. Define this target before you enter the trade, so your risk-to-reward ratio is a cold, hard mathematical fact, not just wishful thinking.
So, as we wrap up this explainer, I want you to ask yourself a serious question. Does your current methodology actually track institutional delivery, or are you just praying a random pattern is going to save you? A pattern without institutional context is a trap waiting to happen. But once you learn to read the rejection, precisely mark consequent encroachment, and nest your timeframes, you stop guessing. You start trading right alongside the algorithm. Until next time, keep your charts clean, trust the structure, and I'll see you in the next explainer.